Hi, I'm Peter Rose, founder of Longwood Currency Trading. I've been getting some communications from you folks recently, more so than in the past. Is Forex dangerous to trade? Yeah, but so is driving a car, or water skiing, or climbing a mountain, or just going to the grocery store. Everything has its risks. As you probably know, if you've watched my channel, I've been involved in the martial arts for over 50 years and have taught hundreds and hundreds of students. And one of the things that I teach is the difference between taking a risk and assuming a risk. Take a risk by running out between two parked cars into the street. You assume a risk by going to the corner, waiting for the light to turn green, looking both ways, and then crossing the street. There's a big difference. You can see that. I don't have to have a lecture on assume versus take. Everything that we do in life is based on your maturity to evaluate what the risk is. What's the risk in Forex that isn't there in anything else that you do? Well, there is none. And all you're going to do is end up losing money. It's not going to cost you your life. So what is the risk? Well, the risk is inherent in the fact that you're being provided with a lot of leverage. It's like buying a piece of real estate. You're safe, quote, if you pay or put up at least 20% of the cost of your house. Many people can't afford that. They have to come up with 10%. But these crazy deals where you put up 5% or 3% of the cost of the house in down payment, that's leverage. You're levering up. The bank is taking more and more of a percentage control over your security. At 20%, hopefully you're not buying something going into a depression or something, so that you might have a year or 2 years of property appreciation at averaging about 5 to 8% a year. So you go 2 years, you've gone up 10%, you put 20% down, you got 30% buffer now. That's how I always did the real estate. And there were times when the market would crash. I lost $1 million twice in my life because of those economic crashes. I spent 40 years in real estate, investment real estate. But I was never levered up in it. So although I'd lose $1 million over my real estate portfolio, I never lost any of the underlying assets. Nobody ever foreclosed on me because I knew how to play the game. I knew what the risk was, and I mitigated that risk. And you've heard me say that word constantly in my videos, is that there is risk, but there are methodologies to mitigate that risk. So when I'm working with someone, that's the first thing we get off the table, is how do you mitigate your risk? Because the last thing you want to do in real-time Forex trading is worrying about your risk. You don't want to worry about it. You assume the risk. Your rules have to incorporate some simple criteria for minimizing the impact of an adverse move against you. And if you don't follow those rules, there's not much I can do for you. Not much anybody can do for you. The only thing in Forex trading, in the currency market, that we have control over is our risk. We don't have any control over whether we get the entry right, or whether we make money, or how many pips we make money. You know, the stupidest thoughts that I've heard on these videos are these people that talk about this stupid risk to reward ratio. You take that should mean you take 1 time the risk for 3 times the reward, which means you're taking a 0.33 risk. What does that mean? The real ratio is reward to risk. And that gives you, oh, I'm taking 3 times reward for every, I'm making, let's say, for every pip that I risk, I want to make 3 pips in profit. So as a 60-40 trader, you're going to come out great. Does that hold up? No, it doesn't hold up. Because you have no control over the 3 pips that you're going to make or the 12 pips you're going to make or what. You have no control over that. So for somebody to say, oh, I have a risk to reward ratio and I want to make 30 pips, and so I'm going to take a 10 pip risk, or I want to make 10 pips, and so I'm going to take 3 pip risk or something. It just doesn't make any sense, because you're not guaranteed the profit. The real ratio that you want to be looking at is win to loss ratio. That's where you can determine from a statistical standpoint where your trading lies, so that you can say, this is where my risk should be. I've got to tap out at this number of pips, not dollars, but I got to tap out at this number of pips in order to have enough pips that I statistically make on the winning trades to make up for that and to provide the profit that I need. How much profit do you need? Those are all discussions that I have to work with serious traders in order to make sure that their risk profile is under control, and then they can concentrate on how much money they're going to make and how to make that amount of money. Somebody will write and say, oh, I want to trade at 200 to 1, and what can you tell me about the secret sauce entry on a RSI and Whammer Jammer combo indicator? And I just say, I can't help you, because I trade at 10 to 1. Everybody was crazy. Everybody that you see out there on Videoland is trading at 100 to 1. Some of them fools are trading at 500 to 1. So if you look, if you've got a $300,000 account that you stumbled your way into somehow, and you trade that $300,000 account at 500 to 1, I will guarantee you will lose it. And they know that, because that's what happened to them all the way through playing this crazy 500 to 1 leverage. They lost the money, and they lost the money, and all of a sudden they got lucky, statistical luck. And they took a $10,000 account at 500 to 1. You're trading, oh God, 40 lots at a time, $400, $500 a pip. You make 20 pips. You're making 10 grand. You make 50 pips. All of a sudden, in 10 lucky hops, you could take a $10,000 account to 6 figures. You do it 2 more times, and you're $1 million. But they know, and along the way they've lost $30,000, $50,000 accounts, and they had to work their way back up and build it up. So when they finally get to a point where they can say, okay, look, I can take $30,000 of the $300,000 that I have, and I can bet that, and if I lose it, I've got another $30,000 that I can add in there, because I know how to trade, and even though I'm using high leverage, I've learned how to trade, so I can take that $30,000 now and turn that into $80 or $90 or $100,000, and it makes up for the 2 or 3 times that you lost the $30,000. It's a numbers game. It's a probabilities game. Are you going to be able to do that? No, not unless you're willing to lose tens and tens of thousands of dollars in order to learn what not to do. Well, the first thing I'll tell you not to do is don't do it at 500 to 1, 200 to 1, 100 to 1. You can't, because you don't know what you're doing. You're not good enough at trading in order to understand the value of having good risk management and getting out of that trade right away. Or you have this huge bank and you can afford to trade and lose a $30,000 account, and you don't tell anybody about that. You just say, oh, I had a $40,000 day today. I made $40,000. Great. How about yesterday when you lost $30,000, and the day and 3 weeks before that you lost $30,000? It wouldn't make you look very good. I lose plenty of money, and I'm at 10 to 1. But in my last video, I talked about those issues that I have from my real estate investing that impinge on my currency trading because the time element is kind of flipped around as far as the risk. Well, I understand that. So on the few times that I slip out of gear, I'll lose $10,000 or something. You know, I'm trading a six-figure account. Now, I'm not going to put all that at risk, so I've got some very specific rules to keep me out of the deep end of the pool if I don't know how to swim. And when you get into high risk, high leverage positions on a, I think this should happen, you're in the deep end of the pool. I can afford to be in the deep end of the pool. I know what I'm doing. I'm not afraid of loss. And I have a good enough win-to-loss ratio that when I buckle down and strictly follow the rules, I can make large losses back. It does cost me time to do that. And I'm getting at an age right now where I'm saying, I mean, I retired was able to retire because of my real estate investment when I cashed out of those. And I'm having fun with the currency trading, and it would have been a nice goal to try to take my account to $1 million, like I made $1 million in real estate. That would have been fun, and I tried that. But in order to do that in a shorter amount of time, I mean, like I said, I've lost $1 million twice in my life because of economic collapse. I made that $1 million back each time, but it took me 10 years each time. Well, you know, I'm going to be turning 75 here in a few days, so I don't have a lot of time to be spending 10 years to try to make $1 million back or to make $400,000 back so I can get back on the track. So I think I'm just going to back off of all that and just have fun trading and, you know, make 80, 150,000 a year, something like that, and that's going to be really cool. And I'm not going to turn my six-figure account into $1 million at $150,000 a year, but I don't need $150,000 a year to live, and I don't need anything from it. But I love to trade. So some of the folks have criticized me for being honest on the videos. Well, you're losing too much money and you hold your trades too long and blah, 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 blah. Fine. I'm trading for a different purpose than you are. You're trading your little mini accounts and you're hoping to make the electric bill. Okay, don't waste my time. Go listen to the guy that's hooting at you that he's going to show you how to take a $10,000 account and run it to six figures because he's trading at 200 to 1 or 500 to 1. You can believe that all you want, but you will lose all your money. Maybe 1% chance that you won't lose your money. Very rare. So is currency trading dangerous? Yes, it is dangerous. Number one, if you don't know what you're doing, and number two, if you don't have good risk management, and number three, if you have higher expectations than the probabilities, the math would allow you to do. So if you put away all that stuff, then you need to look realistically at how you would build your trading plan so you don't lose more money than you're trying to make, to be realistic about it. And in the beginning, when I work with students, I say, look, if you could make 20% against your bank, that'd be great. If you had a $10,000 account, so you were trading one full lot, or $7,000 account, so you could trade one full lot because you need some margin up front, like a down payment on a house, right? I just do 10 to 1, so if I'm going to trade one full lot, I'm going to trade it on 10,000 bucks. U.S. margin right now on the major pairs probably run me about $6,300 of margin, so that leaves me, you know, $3,500 or $3,800 of runway. I don't need $3,000 of runway on one lot. I might need $500 or $1,000 runway on that lot, so I could probably trade that one lot at $700 or $7,000. But I don't. I choose to do it at 10 to 1. So if you're trading a $10,000 account and you can make 20% on that, that's $2,000. That'll pay your light bill. Whereas that's not enough. Well, you need, like they say in the movie Jaws, you need a bigger boat. You need a larger account. Wow, it's starting to thunder out here. I don't think I'm going to have to water the gardens today. I'm going to have to run up and shut off the lights here pretty soon. The poor bow dog is he's stressing out on the floor there. In any event, If I'm going to work with somebody, I'm going to work with them on a $1,000 account to start. Let's get you to the point where you can make 20% return against that account. If you can't make 20% return, then you shouldn't be doing currency trading. It's because the risk is higher. You go into real estate, you can make make 20% investment real estate with cash on cash over your 10% or 20% down payment. That's relatively straightforward. Why would you do currencies when you could make 20% in real estate, or maybe stocks or something, which are I think they're more dangerous to trade than currencies, but a lot of people think it's safer because you're buying General Motors stock or something. I don't know. But that would be nice if you can make 20% against your money, and it's easy. It's easy to do that if you know what you're doing. And that's what I teach. So now, if $2,000 a year isn't enough money, how much money do you need to make? Well, I need to make $40,000 a year. Oh, great. Well, 20% of some number is $40,000. That number has got to be the size of your bank. It's pretty simple. Except, as you begin to improve your win-to-loss ratio, I can teach you how to build positions and stage into positions, whereas when we're starting out, it's just all in, all out process. It's safe. It builds good habits. And then as you increase in your ability level, why can't you make 40% or 60% or 80% against your bank? It's when you know what you're doing, when I know what I'm doing, and I am able to work at a 70-30 win-to-loss ratio on my transaction basis. I win 80% of the days I trade. I win. I win for the day. So if I trade 10 days in a row, I'm going to lose 2 days, right? So I've got good trading habits and good trading metrics, and so I follow those rules for increasing the number of lots that I'm trading, and how to build into a position, how to stage into a position, so you're maximizing the run of price that you're going to get. And I've done months where I've made 10% on my risk. Is fairly common for me when I'm following my rules. I've made as much as 20% on my risk in a month. And I'm not talking about a $10,000 account. I'm trading 6 figures. So you can make as much money as you've got a bank to support, and you could make as much percentage return against that bank based on your understanding of what the Forex market is, how to trade that market, and what your risk management needs to be at any given time based on your win-to-loss ratio. That's how you figure things out. I mean, it's really pretty simple. I don't know what all these guys are doing, talking about Bollinger Bands and Fibonacci's and all this other crap and fundamental analysis and what's the NFP result going to be. Well, I don't know what it's all about. But I will tell you, it's simple, far simpler than you can imagine, and far safer than you could possibly imagine. So find somebody that does it simple and ask them how to do it. But don't get into this if you're just trying to pay your light bill, because you'll take more risks than you need to, and because you'll get tired of paying your light bill. You'll say, well, this is pretty easy. I'm doing it. I'm at my $10,000 account. I'm making $2,000 a year. I'm paying my light bill. Man, I'd really like to bump my leverage and go to 500 to 1, and then I could make $400 a pip, and so now I'm making $40,000 a year. Really? No, I don't think so. Be careful, and don't believe everything that you hear out in video land, okay? Peter Rose, Longwood Currency Trading. Have a great day, and have a great trading day while I run around and shut the windows down, because we've got a blow coming.